The credit crunch is coming, and soon older Americans may be struggling to get access to credit and home equity loans, but the reverse mortgage will remain. Welcome back to the Industry Leader Update. The fallout from the failure of Silicon Valley Bank still remains with us. That despite a generous bailout, courtesy of you, the U.S. taxpayer, and also the Federal Reserve. When the banking stress first surfaced, my primary takeaway for U.S. equity markets was that it would lead to a credit crunch. That said Mike Wilson. He is Morgan Stanley's chief U.S. equity strategist, and he watches these trends very closely. In fact, the credit crunch, we can say, has already begun, and it's going to leave many Americans being unable to get access to various forms of credit. That can range from a home equity line of credit or HELOCs, credit cards, and even traditional mortgage loans. And Wilson adds, the data is suggesting a credit crunch has already started, and the data shows the biggest two-week decline in lending by banks on record, as they simultaneously sell mortgages and treasuries at a record pace to offset deposit flight. Simply put, banks are now looking to reduce their risk exposure amidst an uncertain economy that many expect is going to be officially entering into a recession this year. Yet it's somewhat of a self-fulfilling prophecy, we can say, because economists say that the credit tightening is actually going to lead to a recession and slow the economy. During Goldman Sachs' first quarter 2023 earnings call last Tuesday, CEO David Soloman said, the recent events in the banking sector are lowering growth expectations and there is a higher risk of credit contraction given the environment is limiting banks' appetites to extend credit. Fortune reports that the International Association of Credit Portfolio Managers just released their Credit Outlook Survey. We've included a link just below this video. They released it on April 13th. And the survey reveals a majority of the respondents are now anticipating more loan defaults globally in the coming 12 months. And 86% of those respondents say that defaults will in fact increase here in the U.S. Experts say that the biggest impacts of a worsening credit crunch will be felt on Main Street USA, in smaller towns and cities, especially for credit unions and community banks that have financed local commercial real estate because they're now tightening their lending standards in anticipation of increasing CRE or commercial real estate loan defaults. Now that's especially for those commercial loans that have floating interest rates because those rates keep going up. But at a more granular level, and more importantly, older Americans may find themselves being unable to obtain a home equity loan or could get their credit card limit reduced dramatically by the credit card issuing bank. Now, those reductions in available credit card limits actually increase the credit card holder's credit utilization ratio. Increasing that ratio hurts their credit score. It reduces that score, and that's due to no fault of their own. And that scenario only makes loan qualification even more unlikely for the consumer. However, there is good news for older homeowners. While we're seeing banks reducing the availability of credit, the federally insured reverse mortgage, or the HECM, home equity conversion mortgage loan, and also presently private reverse mortgage loans do offer a means of a financial lifeline or even increased cash flow for those qualified borrowers. After nearly a decade of seeing record low interest rates and very generous lending standards, we know now that the cash cow of credit is going to have far less to offer to meet consumer demand. But the federally insured reverse mortgage lending standards, we know that those are not going to be subject to this credit tightening or national or regional bank lending standards because those guidelines are set specifically by the Federal Housing Administration and HUD. So outside of higher interest rates, if they keep going up, or a change to existing HECM principal limit factors, which we don't expect, the HECM is going to remain a beacon of opportunity for the qualified homeowner who may no longer be able to get access to other loans. That credit crunch has already begun, and it's going to accelerate this year. Mark my words. But how are you going to let your local homeowners know where one loan is declined, a reverse mortgage may be an obtainable option? You can leave your comments in the comment section below on that. And be sure to share today's video, if you would, on your LinkedIn and Facebook profiles. And don't forget, we have a YouTube channel. If you enjoy the work that I put into these episodes each week, If you would kindly smash that like button, that always increases the relevance and the algorithm for this show. And also you can hit the notification bell as well. And don't forget, each and every week we have the reverse mortgage news that you need to know on our HECM World Weekly podcast. Apple users can listen and subscribe on iTunes. Thanks so much for joining us, and be sure to return next week for more reverse mortgage news, commentary, and analysis here at HECM World. Have a great day.